Good morning. It's Monday, the 26th of April, 2021. I'm Rob Murphy, Head of Investment Trusts at Edison Group. And this morning, we're delighted to have Peter Staelens, who's the Portfolio Manager of CVC Credit Partners European Opportunities Fund. And we're going to be covering a few topics about what the fund does, and also the income that it produces. And what's interesting actually is on Friday, the fund just announced an increase in the dividend to 5p a share, putting it on about a 5% yield going forward. So with that, just like to say welcome, Peter.
Thanks, Rob.
Brilliant. And we'll kick off. So the name of the fund is obviously quite long. I'll just sort of shorten it to CCPG just to make it easier.
Yeah, that's
but
fine.
the fund invests in leveraged loans. And I think what would be interesting to view is how you would compare the risk and return profile of leveraged loans to equities.
Yeah. So leveraged loans are in fact the floating rate equivalent of high yield bonds. So the leveraged loan market, or the sub-investment grade loan market, is probably not as well known as the high yield market in Europe, as it's more difficult to access for smaller investors, but it has a fairly similar risk return profile. So investors in the leveraged loan market typically want an income and at the same time less volatility than in the equity markets. And just to put it in context, the European leveraged loan market is just over 300 billion in size, and the average coupon on a loan in euro terms is around 3.5% to 4%, and in sterling it's around 4.5%. So the main difference between loans and high yields is that loans have a floating rate coupon and high yield has a fixed rate coupon. So in an environment where base rates are rising, investors typically want to be invested in floating rate assets or loans. And in an environment where central banks are cutting rates, investors typically want to be invested in fixed rate assets to protect their income. And there are basically three drivers for returns in leveraged loans. There's the coupon you're getting, the default rates, and the loss given defaults. And a lot of people focus on the first two, but they don't really focus that much on the last ones. So basically the coupon is around 4%. And then S&P has done a study where the average loss given defaults over the last, I think, 15 years was around 27 cents. So if you want to be extremely conservative and say the average recovery for a loan if it defaults is 60 cents, so you lose 40 cents, that means that your default rate across the market needs to be around 10% for you to be break even on that 4% income you're getting. It's basically you get 4% income, you lose 40 bips per default, so you need to get to around 10% default rate before you break even. But the leveraged loan market had only once experienced 10% default rates, and that was in 2008. So that was in the midst of a very severe recession. Last year, in 2020, the default rate in the loan market was around 2.5%. So if you think of it, for you to be break even on your loan investments, you need to be in a very severe recession, and in that case, your equities will be down quite a bit more than what you're going to lose on loans. So we feel leveraged loans are quite a defensive asset class at this point in the cycle.
Yeah, that's interesting. I mean, I was looking at the fact sheet, and I could see the fund actually has had a positive return every single year, calendar year, despite we've been through various sort of crises in Europe over the period, including the pandemic, obviously last year. So that's actually quite interesting to see. So you've talked about the track record of the loan market in terms of losses and so forth. So what are the kind of companies then that underlie the portfolio, and what's the investment process you use to choose those?
Yeah. So we typically invest in large companies. I think the average EBITDA of our investments is a couple of $100 million. So these are large companies with liquid cap structures where we can easily trade in and out of the loans depending on our view of the market. Of course, in an environment like last year where pandemic hits and was basically in no one's base case. So there was quite a lot of trading activity in the fund. But if you look back, there's a Credit Suisse Western European Leveraged Loan Index, which was created in 1998. And since 1998, this index has only had 1 year of negative returns. That was in 2008. Again, 2008 was a very special year where pretty much every single asset class was negative. But basically, by investing in large liquid companies, that is one way to protect our downside. So if we feel that an investment doesn't really go as planned, we can easily sell it out and invest in something else. And our process is we go through a very rigorous process before we invest in these loans. So I've got a large team of analysts, and it basically goes to the core of what CVC does. So I mean, we've got a large private equity business, and all they do is they analyze corporates and they look for names that are cheap. We do effectively the same on the credit side. So we analyze corporates and we invest in loans that we think are cheap. So roughly 50% of the portfolio is invested in what we classify as performing loans. So these are loans that trade around par and that pay an income. So that's basically the basis for our dividend distribution. And then the other 50% of the portfolio, we invest in what we call opportunistic credit. So these are loans that for one reason or the other, they've sold off. Could be on the back of rating downgrades, could be on the back of business underperforming their business plan, could be on the back of regulatory changes. So we then go and analyze these businesses and see if there's a way we can invest in these loans at a discount to par. So this process can take several weeks, can take several months. We basically want to get comfortable with the downside protection before we invest in something. And that part of the portfolio really generates the capital upsides we're trying to deliver to our investors.
Right. So really, you're a combination of income and capital growth. Then is the way we should think about it.
Yes, that's correct. So our target returns are 8% net through the cycle, of which we're paying out a 5% dividend now.
Yep. Excellent. So you mentioned interest rates. Obviously, one of the big themes now is people are wondering if inflation is going to run hot. Many central banks have now got sort of average inflation targeting. What would happen to returns in the fund if inflation were to rise?
Yeah, so rising inflation should be a positive for our returns, because basically a loan is linked to Euribor, so it pays Euribor plus 4%, for example. So if you think that base rates are going to increase, that will just flow straight through to the performance of the funds. Of course, there are other ways inflation can impact returns. Earnings may get squeezed by rising raw material prices and all these things, but that is something we take into account in our underwriting process. And we are starting to see some signs of inflation, more so in the US than in Europe right now. But yes, when you look at where commodity prices have gone over the last few months, there's definitely some signs that inflation is picking up. And we've seen, especially in the US, we've seen considerable outflows out of the high yield market and inflows into the loan market, because basically investors want to capture that change in base rates by moving it to leverage loans.
Yeah, that makes sense. So you mentioned Europe. Obviously, you're a European-focused fund. the US and UK seem to be actually progressing quite well with vaccines, but we're in the situation in Europe where some countries are in lockdown again. So maybe you could share how you see things progressing over the next 2 to 3 years for the fund, and what the outlook is for the loans.
Yeah. So it's true that the pace of the vaccination rollout has definitely been slower than expected across many European countries. However, that hasn't really had much of an impact on default rates in Europe. So the default rates peaked somewhere around October, November last year, and has started coming down gradually ever since. So from that perspective, it hasn't had much of an impact. The bigger question is what will happen when all the furlough schemes and all these things run off. But overall, the 2.7% default rates that we saw in 2020 is roughly in line with the historic average, and we would expect it to remain around these levels. It's not going to go down materially, but we don't expect it to go up materially. So and that's really what we need to look at as credit investors. So, and when you look at macroeconomists, most of them seem to predict a fairly sharp rebound in global growth in the second half of the year, and that should be positive for us because, as I said, so about half of our portfolio is invested in more opportunistic credits, and these are the kind of credits that will benefit more when growth picks up. So overall, we remain quite confident on the outlook for the near-term future.
Yeah, I suppose that the question on the removal of the support schemes is interesting because I guess you're focused on larger companies. I think it's a 500 million average EBITDA, something like that.
Yeah.
And I think the experience has been that larger companies have generally done much better than the smaller ones. And I mean, do you think the smaller ones are the ones that potentially are more at risk as those support measures are withdrawn?
Yeah, I believe that's true. I mean, a lot of the large companies, they have access to capital markets. They have been able to raise loans or bonds or even equity to fund the cash burn that they experienced during 2020 and the first few months of 2021, while many countries were in lockdown. So yes, it's true that the larger businesses tend to perform better in a difficult economic environment, and that's why we invest in these larger businesses. Not only does it allow us to risk manage our positions better, but these businesses are also able to attract more capital. They tend to have better management teams, and they tend to have more access into government schemes and furlough schemes and all these things. So in general, we like to be invested in large companies, and you can maybe get slightly higher yields by going into these smaller credits. But if something goes wrong there, your recovery tends to be quite a bit lower.
Yeah, great. That's clear. So let's come back to Friday's announcement. So the board's announced an increase in the dividend from 4.5p to 5p, and also a reduction in the management fee from 1% to 0.9%, with some additional step down provisions. So as the fund gets bigger, actually the average fee will come down. What are the factors behind these changes?
Yeah. So our dividends was increased on the back of a very strong start to 2021. So we were up 4.4% just in Q1, and that's a net return. And most of our investors invest in our funds to for the income, and so we thought it was right to increase the dividend from 4.5p to 5p. In terms of the management fee, we reduced the management fee slightly. Again, there is this is a competitive markets, and ideally we would like to grow the size of the fund so that there is more liquidity in the underlying shares, and hopefully we're sending the right signal to our investors by reducing our management fees.
Yeah. And actually, I was just looking at, you're trading very close to NAV at the moment, so so the possibility of being able to grow further looks fairly good at the moment. Well, that's all my questions, Peter. Just like to thank you very much for your time and presenting the CVC Credit Partners European Opportunities Fund.
Thanks a lot, Rob.
Thank you very much.